Now we're going to turn to Europe. And before we do that, I'd like to remind you, please like, share, subscribe. And in the previous segment, I had said that I think I said it was 1 option to 10 shares. I meant 1 option to 100 shares. And the reason why that's important is because of the leverage and the exposure. So if you buy an at-the-money call, so if you buy 1 at-the-money call, that gives you a delta of 0.5 or exposure to 50 shares. So you're technically buying 100 shares exposure at the cost of, some percentage off of that 0.5 delta. So again, these are things that people have gotten savvy to or have at least been able to get a fairly cheap amount of product or leverage to utilize. But now enough about that. On to the Eurozone. So the one thing that we wanted to look at is when we start talking about some of the recent impacts and components. So when we look at France, you can see industrial production slowed down versus expectations, but that's something that has reversed in June. So we expect this to actually get better when we look at industrial production. Manufacturing production also slowed in May, but that has gotten better in June as well. And you're seeing that show up in the PMI, because when you look at services for Spain, when you go across the board, Spain up, 60.6 was expected, came in at 62.5. Spain composite 60.5 came in at 62.4. Italy service PMI 56.2 came in at 56.7. Same way, and so clearly the trend is there. Germany had a little bit of a slowdown, where expectation was 58.1, came in at 57.5. German comp is expected at 60.4, came in at 60.1. So still expansionary, but slowing. And we'll talk about specific components within Germany that is impacting. And then when you look at the Eurozone services, as an aggregate, things got better. But the investor confidence slowed down a bit versus estimates, but still better versus prior for July. So you're still seeing people feel better about the economy and move within a better subset. Now, when we look at the Eurozone aggregate data, the PPI is I think an important one, because you're still seeing prices going up. So PPI month over month expectation was for 1.2, came in at 1.3%. Prior was 1%, or revised to 0.9%, and then the year over year came in at 9.6%. So you're still seeing some of those movements going up. And then retail sales for May, a little bit better. That's going to continue. Things are starting to continue to move forward. But survey expectations for July dipped a bit to 61.2 from 81.3. That's a mixture of, things have gotten a lot better. You've started to see things run a bit hot, but then you started to see some of that pullback in general. And when you look at it overall on the overarching theme of survey expectations, you're starting to see some of the adjustments, Delta variant, some COVID issues popping up again, which has caused some of that to lessen, but still a net positive and still in a better form. Now, I just wanted to highlight Germany here, because when we look at some of the slowdowns on PMI, it's important to look at factory orders, because factory orders in May, as we were saying, were a little bit worse. We expected them to be worse. Now, they get a bit better in June, but not 100%, because when you look at the leading indicators on exports, imports, car production, they remain soft. And that's where a lot of this is going to come down to. So factory orders month over month came in expected at 0.9%, came in at negative 3.7%. And when you look at German construction, you can see that that's still in contractionary mode, still at that 47, with expectations getting a bit worse in terms of the survey. Current situation getting a bit better. So expectations, again, some of that softness because they're seeing some of the issues in Asia and within their own economy, which again is starting to deviate, with industrial production pressing lower, coming in expectations at 0.5, coming in at negative 0.3%. So again, there's some of these pressure points that are going to persist, especially in Germany. So even though Europe is going to get better, Germany is going to be a bit of an overhang, and not that it's going to contract, it's that it continuously just is missing estimates a bit. It's just not getting to where people need it to be or want it to be in general, and that's where some of those pressures are just reside within the market. So then when we just look at the PPI side, in terms of where some of this is moving, because this is an important piece of how prices are, how they come up with prices. What is your cost in general? So here you can see just where things are going and how there's month over month, which is obviously the better indication, because you're just seeing that steady growth and that acceleration. And then when you look at the year over year, you not only have that base effect, but that month over month growth, which is exacerbating the current issue. So then when you look at that construction PMI within Germany, you're back above this highlighted area, but you're not seeing that expansion. There's still that overhang that remains, and it's on raw materials, it's on cost, it's on the consumer. There's this propensity to save and to avoid. There's obviously a key election coming up. There's some uncertainty about that. A lot of these things are just going to weigh on some of that German activity, which is why Europe will be better than most. You'll see them grow, but I think that they're going to disappoint expectations, and it'll be on the back of some of the German softness. So then when you look at what has happened with the debt ratios and deficits based on the stability program. So when you look at Italy, the Italy deficit continues to rise. And if you remember, the Euro area countries they're supposed to reduce their deficits to below 3% GDP threshold within the forecasting horizon, especially some with high debt to GDP ratios, Italy, Spain, Belgium, and France. But that's what they're supposed to do. So some Euro area countries are not planning to reduce their deficits to below that 3% of GDP threshold, while several others, including the former program countries of Greece, Cyprus, and Portugal, are planning for comparably smaller budget deficits. The Euro area coverage debt to GDP ratio is projected in the stability programs to exceed 103% in 2021, implying an increase of around 17 percentage points compared with the pre-crisis level in 2019. So this is where we're seeing some of those pressure points. You're seeing a lot of these things go higher, and even in 2024, you're not seeing them move down all that much, because you're seeing a lot of that debt continue to get pushed into the market, and a lot of these pressure points just moving into the system. But they're still going to borrow. The rates are still there, and until that changes, it's going to be difficult to see this spigot essentially turn itself off. And by that point, will they be able to, given the GDP to debt ratios that currently sit within the EU? So then when you look at German retail sales, again coming back to some of these pressure points, because they're not at pre-COVID levels in terms of where we were pre-COVID, but you're getting, you're back on trend, or you're back above trend, which is a net positive when we look at some of the aggregate data. And it remains the case where when we look at Eurozone retail sales, back above that level. But then when we look to Italy, still a little bit below. So it's a mixture. Germany's better, France is better, Italy's still a little bit lower, Spain, same thing, but you're starting to get a little bit of this normalcy back within the consumer side. Obviously travel is still hindered. You're not seeing people move around the same way, but you're starting to see some of that normalcy come back into on the consumption side. Now, when you're looking at manufacturers in the Euro area, the lower inventories and surging costs, the U.S. is not the only one. And that's why when we look at what's coming and how this is going to manifest itself, companies are price takers. And then because the product stocks are so low, they have to pay whatever the going rate is, and then they have to increase prices. And this is just showing what that selling price outlook is based on what their stocks are and what they know their supply chain to be going forward. So when you take that and you break it down into different pieces, well, let's look at auto production, which keeps falling in June. So remember, we saw the May data for Germany. So now let's look at the June data, where the June data has only gotten worse. And that's where we continue to see some of these shortfalls, which is why Germany doesn't get better in June, even though some of the other countries like France, that does get better. So in June, we will see a benefit out of France, but it won't really be enough to offset Germany to the point of growth. It'll offset to keep things fairly in line with, I think, estimates, but you're just going to see Germany continue to struggle, not so much because of their own issues, but just the issues that are outside of their control in terms of supply chains, shortages, and issues that remain in the system. And this is why when we look at industrial production, when you look at the automotive side, that is where we continue to see those slowdowns, as we've been talking about, rolling through the system and just getting consistently worse. So it was a fairly light European data, that will pick up next week. So we'll have a little bit more data to talk about, but that just gives you a brief overview where Europe sits, where some of the pressures are, and then how Germany's, I think, going to be the one to watch to see can they see some growth given some of the headwinds that have been persistent in their industry, which will be an interesting one to watch. But the next segment, on to Asia and what comes next.